Hello and welcome everyone to my YouTube channel. We are here on chapter number 12 of this year's economic survey. As you know very well by now, in this series we are summarizing the economic survey of financial year 25 chapter by chapter. We have already done first 11 chapters. I hope all of you have been through that. This is the turn of chapter number 12. If you are new here, I request you to do a few things. Number one, if you have not hit the subscribe button, please do that. If you want the PDF of these classes, you can join my Telegram channel. The link of that is in the description of this video, where I upload all these PDFs, so you can use that to revise later on as well. If you are someone who has PSIR optional, then you can check out my PSIR optional course on my app. Again, the link to download my Android app is in the description of the video. The name of the app is Harshmeet Study Circle. Now, with that out of the way, let's begin with what chapter number 12 has in store for us. Chapter number 12 is titled Monetary Management and Financial Intermediation, Credit Growth with Financial Stability. In simple terms, it looks like a pretty heavy title, but in simple terms, this particular chapter talks about the status of financial sector in India, mainly about the banks. So it talks about how the NPAs, that is the non-performing assets, have changed over the years, increase or decrease, what influence the other factors have had on this, and where do we stand looking forward? What is the RBI stand? What is the RBI doing to improve the health of the financial sector? These are the things that this particular chapter number 12 talks about. So let's dive deep into what it says. So in the introduction, it gives a good news. The good news is that the gross NPAs have declined to a 12-year low of 2.6% by September 2024. Now, if you remember, just a few years ago, NPAs were a big problem and a big headache for the government of India. The RBI had been telling that many banks may go on the verge of collapse if they don't control their NPA, especially in the public sector banks. The situation has become much better now. The other aspect of this chapter is that the financial inclusion index, that is how many people can attain financial services, the financial literacy, that also is on an increment. We have seen this number go up to 64.2 in March 2024, especially with the influx or especially with penetration in rural banking. A lot more banks being opened up in the rural areas, many people getting credit easily as compared to earlier. All this has led to a good score in the financial inclusion index as well. The first part of this chapter is about monetary policy and liquidity management. As you know, the monetary policy is handled by the Monetary Policy Committee of the RBI. They are the ones who have to target inflation. They are the ones who can change repo rate, SLR, CRR, with the common intention of keeping the inflation in check in the country. These are some important decisions that RBI took throughout the year as per this chapter. RBI kept the repo rate unchanged at 6.5% for most part of the year. In December 2024, however, the CRR was reduced. Now, when CRR is reduced means the banks were allowed to have more free cash, so they could give loans easily. That led to infusion of more money in the market. So people's purchasing capacity was improved. It injected 1.16 lakh crore into the banking system as cash supply. Money supply grew by 9.3% on an year-on-year comparison. So these were some of the good things that the RBI did for our economy. What about inflation? Inflation targeting, as I said, has been 2 to 6%. This is the ideal range where we want to be. Core inflation softened. Core inflation is the inflation removing food and fuel. That softened. The commodity prices softened, although it is still increasing, but it's not as drastic as it was. Money multiplier, that also tells us about how much money is in the market, also increased, means there is more money in the market now. The banks are open, or that they are happy to give more loans as compared to earlier. Let's now talk about the banking sector performance. How did it perform in the past year or so? So first, it talks about the asset quality. As I said, the good part is that the gross NPAs reduced. They have fallen to a 12-year low. So recoveries have been better. Provisioning buffers have also been better. There are strong indicators that the banking system is becoming strengthened, and there is lesser risk of bank going bad. Capital to risk weight asset ratio also stood at 16.7%, which is much better than what the common minimum requirements are for the bank. This is a comparative table to show you how the NPAs have been declining since FY21. So as I told you earlier as well, in most of the cases in the prelims exam, rather than asking you the exact figure, the question is mostly created to ask you about the trends. So for example, the question can be, since FY21, there has been a declining trend in NPAs every single year, which is true. So as you can see, NPA, gross NPA is declining every year, which is a good sign. So these are the kind of things. Rather than trying to remember the exact number, exact data, you can just remember the pattern. Is it increasing or decreasing? What about the credit growth? Credit growth has moderated 11.8%, means how much loans are being given. As compared to last year, the growth is low, but it is still growing. Deposit growth, that is the money that people deposit in the banks, is also increasing by 11.1%. There are different types of deposits. Term deposit means money that will be given back to you after some years, like FD, fixed deposit, that you get after a few years. Savings account deposit are called as demand deposit. You can demand it from the bank at any point of time. So term deposit outpaced saving account deposits. So there were more term deposits, people giving money for long term. Banks also like that because it gives them more stability to loan out this money. They know that people won't be asking for it immediately. This is how the bank credit and deposit has grown over the years. It's not a straight line in this section, credit growth. As you can see, this year's credit growth has been lower than last year, but at least it is still growing. What about financial inclusion? This is one thing that we should be proud of, we should be happy about. Rural banking penetration has increased in the country, because of which financial inclusion also has seen good numbers. Financial inclusion index, as we discussed in the intro, has improved to 64.2 by March 2024. This is a result of much higher penetration in rural areas, so many more people in the rural areas now have access to banking services. We have seen Jan Dhan accounts also being expanded. We have seen digital transactions such as UPI also increasing. All this has led to a positive number in the FII. This is again a score of financial inclusion index. Again, as you can see, it's an increasing trend. Every year it is improving from 2021 to 22, 23, 24. It's an yearly number that comes out. So we will have the March 2025 number also very soon coming out. Rural financial institutions have played a big role in improving FII, because this inclusion has mainly come in from the rural areas. Regional rural banks, microfinance, NABARD, all of these have opened up their coffers to give out loans on easier terms to people in the rural areas, especially in agriculture. That has led to an improvement in the FII as well. What about the capital market, financial market? India's stock market had been moving for a long time. So, which is why a lot of money was attracted from within the country and from outside as well. Especially important sign is that the retail investors under the age of 30 have increased significantly. 40% new investors that entered the stock market were under the age of 30. The number of IPOs, companies going public, have also increased, giving more clarity to those investors, giving them more options, and bringing these companies under the purview of SEBI and other regulators as well. The bond market and the non-banking financial companies, they also gain prominence. The bank share in the total credit has declined from 77 to 58%, means the 42% loans that are given out are not given by banks, they are given by non-banking financial companies and the bond market. This also is an interesting number. RBI does not prefer that. For RBI, it's much safer. They prefer most of the loans going in from the banks, scheduled commercial banks, but they can't reach everyone. So there is an alternative in the form of NBFCs provided. At the same time, there are still challenges and risks in the financial sector. We are not over and above that. First, the consumer credit in the banks have increased from 18.3 to 32.4%. Means there is much higher retail borrowing. So at the retail level, the borrowing is much more. So more money is going into retail loan takers and not the corporates. Unsecured personal loans, against which you don't give any security, credit card borrowings also have increased considerably. It's not ideal for an economy to have a lot of outstanding credit card loans and personal loans, because when you don't have any guarantee against the loan, then there's no safety of that. If you don't pay it back, the bank really can't do much. That is why it is a cause of concern. Also on the financial market, there have been a lot of people depending upon this market to increase their money. As you have seen in the past few days also, there has been a downfall in the stock market. So it does have its own financial risk, which is also pointed out. This was our 12th and second last chapter. I have a few questions to test your knowledge here. First, which of the following measures is RBI implement to infuse liquidity in the banking system in FY25? So which of these will infuse liquidity? liquidity. Repo rate increase, no, it will reduce. Reduction CRR, yes. So reduction CRR means banks have to keep cash amount in their hand to a lesser extent. Now they can give out that money in the form of loan. That will increase liquidity in the market. Next, what was a primary factor behind RBI's decision to increase the risk weights on unsecured loans? Because of rapid rise in unsecured lending. As we discussed, unsecured lending means credit card borrowing, personal loans that are unsecured. This is increasing, so RBI is not happy with that. One last question. Which segments saw the fastest growth in financial market participation FY25? We discussed this. It is the retail sector under 30. This is the one that saw the most growth as compared to others. This was the second last chapter. We have one more chapter to go. Do join me tomorrow when we discuss the last 13th chapter. Thank you so much for watching. Bye-bye. Jai Hind.